Star Peak Energy Transition Corp, or STPK Spac, is merging with STEM. The deal is expected to close during the first quarter of 2021, where STPK Stock will convert into STEM stock. So what is STEM? STEM is a hyper-growth energy storage leader. Why is this important? Now, energy storage is expected to grow dramatically in the years ahead as companies seek to lower their carbon footprint and lower their energy costs. Energy storage also plays a critical role with the intermittency challenges of core renewable sources like solar and wind, where it's, you don't have solar all day long. So where does STEM fit into this whole equation? They're an agnostic seller of the storage hardware, and critically, they also provide the software for intelligently managing one's energy usage and redirecting it back to the grid. While I think STEM is an impressive company, heck, they're projecting over 300% revenue growth in the next year. I think that's the first deal I've seen of all the companies I've looked at that is projecting over 300% revenue growth in 1 year. So you definitely have something going on with that. We'll go into that in a little bit. The stock price, though, has run up quite a bit since the deal was announced, and based on the valuation, I'm less confident about its risk rewards. It still has, dramatic potential upside, but if you start thinking about valuation longer term, that might just drag on your prospective returns. This video goes out to Andrew, David, Michael, Nick, Richard, and Tenzing, along with all the Unrivaled Investing Journey subs. About that, a quick 10-second plug, if you will, where I'm Daniel, you're watching Unrivaled Investing. This is a no-hype, mission-focused channel to try to find you exceptional companies and unrivaled investments. If you enjoy learning about potential multi-baggers, types of companies that can go up hundreds or thousands of percent, make sure you subscribe. If you're already a subscriber, that thumbs up helps with the proliferation of the video. And if you want to follow my personal journey to see what I'm buying and selling, go to unrivaledinvesting.com, click on Journey. Whew. Now let's dig into STEM. Let's find out what this whole deal is about, and is it such a promising company? So what's the deal? So you have Star Peak, which is currently STPK Spac, merging with STEM. The sponsors are getting a very sizable percentage of this deal, 7% of the deal, just for doing the deal. So their incentives are always a little different than yours. That said, it's still a pretty interesting deal, as you have effectively $600 million coming into the balance sheet, and almost all of it going to the balance sheet, with the exception of repaying a little bit of debt and fees and expenses. The vast majority is saying, hey, how do we keep putting up fantastic growth into the years ahead? So what is STEM? So STEM operates the world's largest network of energy storage systems. Now, what's that mean? So you need to think of it as three different components that go to this business. One is the hardware, the batteries, the network integration that goes with a company, or that goes with, a utility that has, let's say, a big solar farm or something like that. So all these batteries that can store a lot of energy. And then you have the software, and they have 100% sort of lock-in saying, hey, if you're going to be buying the hardware, and we're hardware agnostic, so we'll sell any of these different providers, but we are going to have a 100% attach ratio with our Athena operating system, effectively. That is the optimization of how is the data, how is the energy coming and going from the battery storage. How do we make sure we're doing this right? Because this effectively, this AI is connecting to the grid and saying, hey, what are prices now? What are prices at this time? It's being updated every minute in terms of saying, oh, okay, here are the prices now. Maybe we should be pulling from the grid because it's midnight and prices are low. Oh, it's 2 o'clock in the afternoon and prices are high, and maybe everyone's running their AC right now because, let's imagine it's the middle of summer and everyone's running their AC and it's hot. It's like, oh, okay, let's redirect, energy back to the grid using the batteries, because maybe we have the full power from solar at that point. Then this last component, this is sort of a reach component. This isn't something you're going to see really tangible, at least in the immediate term, which is this market participation. The way to think about that is, if you have enough hardware, network, battery storage capacity, can you sell back that energy back to the grid in an intelligent way and get sort of a rev share with STEM, where STEM gets a cut of the business for redirecting it back to the grid? So is this a real business? I mean, this looks like it's super exciting and cool stuff, effectively selling hardware. You have the software business, and then you have a rev share business or market participation. But is this actually a tangible business? Like, is this real? And I would say yes. Like, based on the data, they're saying yes, this looks very real. 900 plus systems operating or contracted, all in total, including the contracted systems of 1 gigawatt hours, which is quite a bit. Systems operating in 75 different jurisdictions, 200 plus cities. You're looking at a global enterprise. Where they've had incredible bookings and they're projecting dramatic growth in the year ahead. And you can see the amount of storage capacity that's been commissioned by STEM versus several of their competitors, and how they are one of the leader in worldwide developments, looking at data from 2014 through third quarter 2020. So why is this? Like, what's actually going on here? And so you need to understand the different usages. So we'll start with commercial, and then we'll go with sort of the utility perspective. So here it is, using one's battery storage, which is this stuff or this stuff. These companies, let's say they put up solar panels and then they put up these batteries, and these are their customers. So these are real customers that they have. These aren't just pie in the sky customers. This is a real company with real growth, real tangible aspect, real meat to the potatoes, real meat to the bone here. So you using one's battery storage, you recharge when the grid prices are low from, let's say, 11 p.m. to 3 a.m. And that's kind of what you can see here. Like, hey, let's charge up the kilowatt hours here when prices are low, and then when the grid prices go back up, hey, we can plug it back into the system or redeploy it into our own system because we need to use X amount of energy. Maybe our batteries don't cover the full amount, but at least helps. So what's that mean? One is you can have huge cost savings potentially because you're actually using energy at this price or at this price versus at this price. There's grid resiliency because instead of using up this much energy during these, let's say, peak hours, you're only using the delta here. So it's better for the grid. And the grid oftentimes is using, fossil fuels to run the power plants. Maybe it's a gas powered plant that's ultimately powering your electricity. In which case, if you're using less of the grid at that point, it's net favorable for the environment. So you do get this decarbonization aspect. So it is this win-win across the board, and it's sizable savings you could potentially be getting. This delta, effectively what your costs are at 3 a.m. versus 6 a.m. or 10 a.m. of 10 to 30% monthly electrical bill reductions. And they're saying 35% of the Fortune 500 have committed to carbon neutrality. I mean, this is the right way to make it because, it has this win-win with the environment and people generally like to see it. So this is a good wave to be riding. This is not pie in the sky. This is, companies are getting a tangible benefit, and they're real companies saying, hey, maybe we have this huge warehouse. Let's just put solar panels on it. What are we doing with all that energy? Let's put it in a battery when we're not using it. So that way, the next day at this time, maybe we can use more, or we could store it, overnight, or, what have you. So that's the commercial application where it's cost savings, grid resiliency, and decarbonization, where it sort of fits on all sorts of needs. Let's look at through the angle of the utility, where renewable utilities companies will use it as well to match, let's say, solar generation with the demand level. So let's say you have a ton of solar capacity that's coming online. It's like, okay, we have so much solar right now, and let's just let's save it effectively for later. So if you're able to, hey, let's package this up and reuse it again when we're storing it in our batteries, and we're going to save it for when prices are good. Maybe you start getting sunlight first thing in the morning at it's 4 o'clock in the morning and early sunrise, and you're starting to get sunlight, and you don't quite need it because prices are still low. Put it on the battery and put it out for later, and then we'll redirect it to the grid when the grid is more taxed or prices are higher. And so this results, and this is a figure that struck me as really interesting, as 10 to 30% unlevered IRRs, or return on investment, internal rate of return on investment. That for investments is quite attractive, especially they're saying it's unlevered. If it were levered, that means it could be even higher. So this strikes me as a no-brainer, and you're going to see more logos fill this out as more and more utilities, especially utilities with a renewable angle to it, want to get a better return on investment, this just seems like an obvious play of like, hey, not only, if we have a solar farm, we also need to have the batteries that go along with it, so that way we can save it and redeploy it when it's optimal for it. And this obviously helps grid stability, just like with the commercial applications. So this strikes me as super obvious, super long term, that this is going to win along with the commercial aspect. So both of these strike me as very real applications and very attractive sort of setups. This is a 10 to 30% IRR for a utility company. Usually utility companies are levering up. So usually their levered IRRs are 10 to 20%. So to say unlevered 10 to 30% means using debt, it's going to be even higher. So this is a very interesting setup. So ultimately, at the end of the day, what is the actual business model, though, that you're looking at with STEM? Like, how do they actually make money? And this is where the attractiveness of their prospects sort of meet the reality of how it is today, where you have this hardware aspect where you're selling the hardware. And keep in mind, they're hardware agnostic. So they benefit from whoever is either lowering prices or coming up with better tech. Oh, this week, LG has a better battery. Great. Oh, this week Tesla's rolling something out. Great. We're agnostic. We're happy to roll it out. We only mark up somewhere between 10 and 30% to get it integrated. So it's plugged up, plugged, on site, plug it into the grid, and we're only getting about 10 to 30% markup. This is very small gross margins. It's hard to have lots of profit on a business purely like this, on a hardware business. But they do benefit from a competitive battery market. So as different players compete on the battery front, they will be a winner. The next aspect is this software business, which has a 100% attach rate secured by 10 to 20-year contracts, i.e. you put in the batteries and you're going to be paying a recurring revenue for the next few decades, which is a beautiful business. They say 80% software margins, and that totally makes sense. And it's effectively saying, like, look, you need to make sure these batteries are being intelligently managed, using it when you need it, not using it when you don't need it, looking at how the energy prices are on the grid, looking at how the grid's doing, and sort of managing all that, optimizing your energy usage relative to everyone else. And that ability is a recurring revenue, effectively, or a recurring cost for customers. So this strikes me as super interesting. But the vast majority of their revenue, because it's so early days, is going to be on this rolling out of the hardware. This will gradually get more traction as you have more and more customers. Now, keep in mind, they already have plenty of customers, but it's just going to take time. The last component is market participation. As you're going to see in a minute, it's going to take years for this to actually be even a material aspect of the business. It is immaterial as far as you should be concerned. But it is tied to multi-year contracts, and it will have very high gross margin. It's really just saying, hey, if they call it market participation, I'd prefer to call it revenue share, which is based on the amount of energy you're sending back to the grid, they're going to get a cut of it, and they're going to get, effectively get revenue from it. That's how I'm reading what this market participation rate is. Recognize when realized, and it's going to be over many, many years. So, but at this point, there's just not enough energy, and the prices just aren't significant enough. And keep in mind, this is a key component of having scale, where having scale is an advantage, because if you have enough players, you can create market participation where this becomes a meaningful source of income in the future, and it's very high margin source of income, 80% gross margin. So this could help set you apart in the years ahead. So how I think of this, I think being an agnostic seller is a favorable position to be in. Having favorable software is a good position to be in. Being one of the number one, effectively integrators rolling this out is a great position to be in. It reflects that you're winning market share and you're doing something right. And this is sort of just, a cherry on top of the whole thing, is if you can ultimately get enough scale with enough customers that you start coordinating this sort of revenue share across many different customers. So what's the outlook of the business, and what's actually going to drive the business? And so I'd argue it's bookings and deliveries. That's the ultimately what drives this engine. That's the fuel that's going to drive the company in the years ahead. Like, how much are they booking this year and how much are they delivering this year? And so, there's a couple of aspects to this that make me, that I just need to call out as potential, not red flags, I'd put it as yellow flags of minor concerns, where, for example, in 2019, you saw deliveries jump from 64 million to 92 million. That's a very nice jump. But then you saw deliveries drop in 2020. And so then to say, hey, it dropped here, but then it's expected to ramp back up to 330, that's something I'd want to have greater clarity on, and just management hasn't called it out yet, partly just because this is the SPAC process where you don't have as much information as you'd like. So that's one aspect. Another aspect about this that I should just call out is that bookings, have gone from 129 to 197, 197 to 321. So this is material growth, but still it's 50, 60% growth here to here and here to here. So 2018, 2019, 2019, 2020. But then they're projecting like 90% growth from 2020 to 2021, and then they're expecting bookings again to grow, to double again. So you are seeing this sort of acceleration in bookings, where I'd also want to understand greater detail. Well, wait a second, if you were growing at 50 to 60% a year in the previous periods, why are you assuming an acceleration in growth? There is a delta there that I think needs to be accounted for. That said, look, they are riding this huge wave, and it's very possible that they're somewhere in the vicinity of these figures. I'm not saying for sure they'll hit it, but they're effectively saying, like, look, you're going from 321 million in bookings in 2020 to a 10-bagger within, a 10, nearly 20-bagger within 5-6 years. So, that's quite a bit, and not many companies can achieve that. We'll see if they can. It's exciting prospects, certainly. So what else? So this is a yellow flag where I would say, is this because the sponsor's getting 7% of the deal that they're just going to put up whatever figures they want just to let's just close this deal, versus like, well, wait a second, what's reality? Is 60% bookings growth really closer to reality versus this 100% plus growth? So that's something I'd want to think about. So we've looked at bookings, but then that needs to translate into revenue, and as you can see, revenue is far lower than bookings. Now maybe bookings, includes this like 20-year software contract, so that's part of the reason why bookings is always so much more than revenue. But still, holy smokes, look at this revenue, where you're seeing revenue go from 7, 17, 33. So growth did, decelerate a bit in 2020, but then holy smokes, 345% growth from 2020 to 21. Like, are they going to really achieve that? And also, before diving into how realistic is 345% growth, which alone is just a mind-blowing number if they're able to get to it. But one should understand what they're really saying here is that pretty much for the next decade, the better part of this next decade, this is a hardware business. This is a low-margin hardware business, and 2026, pretty small portion of the business is the software part, and this market participation, I'd argue it's immaterial. Now, if you were to look at this on a margin basis, it's probably going to be closer to 50% plus, but still, this is worth understanding that so much of their business is tied to hardware, which is much lower margin. So whatever revenue figure here you have, you're going to need to think that the margins are going to be, the consolidated margins are going to be a bit lower. Let's dive into this. Is going from 33 million in revenue to 147 million in revenue actually realistic? And this is what really blows me away, is where they're saying, look, we have a bunch of executed contracts, and that makes sense based on the sizable bookings that they had, 145 million in bookings that they had in 2020. And they're saying, we can say, where our target's 147 million, we can say 88% of this target is from executed contracts. They are very confident that they can do it. And then they're saying, we have 14 times coverage from existing, from either near-term pipeline contracts or contracts that we're going to sign, probably get soon. This contracts that we're probably going to get soon, which represents $240 million, effectively is 14 times coverage for the 12% that remains of hitting that target. So I think looking at this with nearly a 90% saying, hey, we're already there in terms of the contracts. And keep in mind, these contracts have heavy penalties if let's say Home Depot were to walk away and say, you know what, we don't need this storage system. So heavy, termination penalties for a walk away. So I think, look, with 90% lockup, they're effectively saying, like, yeah, we think we're going to do it. So then it makes me wonder, like, wow, 14 times coverage of this 12%. I wonder if they're going to exceed their expectations significantly, or are they, maybe they're just sandbagging what they actually think they're going to do, at least for 2021. Maybe the outer years are sort of a reach, but maybe 2021 is just like they're completely sandbagging. Maybe it's 400% growth next year. And so then I just start wondering, well, even if you do have that growth, I wonder how much is priced in, because that's the market for you. That's the challenge with investing, is like, it's, as people figure out, oh, this is a great company, it gets priced as such, and then your returns, take an impact as well. So you always have to factor in quality and valuation at the same time. So I'm looking at this and I'm thinking, you know what, especially as the price has gone up so much, and we'll talk about that in a minute, that I suspect that people are sort of expecting them to exceed this revenue figure. I think that's sort of being baked into the price given the dramatic run up. So what else do we see? So these are the projections that management's laying out for the greater detail. And overall, look, it's a beautiful business model. Be agnostic, sell. It's a razor blade model. Sell that hardware at a low margin, lock them in a high margin software, add a lot of value with your software, so that way it's harder for other integrators to get that business. And ultimately, you're not competing on the hardware for the most part. You're competing on making sure you lock up that long-term profitable revenue streams. And longer term, you can get that revenue share, that market participation. That's even better. And so, you could see, what they're projecting, 33 million to 147 million. Maybe it's closer to 170 million. Who knows what the figure is, but, good chance they hit this. You see a pretty dramatic slowdown from 348 to 115 to 67. So it does go down a bit, but look, beautiful business model. And also, a key component that I haven't addressed is, as they get this bigger and bigger network of all these different companies using batteries at different times, different locations, they're going to build the best AI for handling battery management, handling energy management. So that way they become better. So whoever has the most data will have the best fine-tuned AI. So that way people can get, either the utilities can get the best return on their investment with their battery storage, or commercial companies are able to save even more on their costs. So I think this is an advantage of more data, better fine-tuned AI. The agnostic seller hardware strikes me as a beautiful aspect of just capturing share over time. And you can see how this translates into really sort of incredible growth, where they're saying, look, within the next few years, we think we're going to be within 5-6 years, we're going to be $1 billion revenue company versus 33 million in revenue in 2020. So that's obviously a hyper growth story that gets people excited. Their gross margin, if this story plays out, should dramatically expand as you're layering in more and more software contracts, those 80% margin software contracts. And so you see, gross margin will steadily go up, and it'll probably keep going higher, from 35, 38, 41. It'll keep going higher and higher as you layer in more of this 80% gross margin stuff. And it's interesting to show that they're effectively expecting to be free cash flow positive, break even, by the year after 21. So 2022, break even then, and significantly cash flow generative the year after. So this is really interesting, and you can see the type of margins that they're penciling out there. This I'm a little skeptical on, in all honesty, saying, hey, we're going to have 40% gross margins but 36% EBITDA margins. That difference just strikes me as too low. You're going to have, 5% G&A, you're going to have at least 5-10% R&D for making sure you build out, your Athena product. So I'm skeptical of sort of having a 41% gross margin and only 36% profit, effectively operating profit. That said, it is a capital light business. It's not like they have to buy a lot of hardware that goes on their balance sheet and then they sell it. It's a risk, that's a risk that they don't have to take. And so having a capital light business model definitely does make it easier for them. It does make it possible for them to put up sort of these eye-popping growth figures. So it is super interesting. I'm just a little skeptical on this EBITDA figure relative to what they think their gross margins will be during this time frame. So what are my thoughts on valuation? And as usual, this is part of my value proposition for my loyal YouTube subscribers, where I provide a link to this in the description of the video. So you just click on that. You click file, download to play around with it yourself. And at the end of the day, I like having a logical framework. Could it go higher or lower than this framework? Of course it can. But I just like to work from a position of logic versus a position of hype. So, and could it go higher or lower? Of course. So as I look at this, first of all, the share count needs to be updated. The presentation shows around 135. That they put a footnote that says it doesn't include warrants. So you probably need to factor in at least another 10 million just based on the peak energy STPK warrants that are outstanding. There's probably even more options and warrants that are going to management that wasn't called out. So I'm using this sort of as a placeholder, using the current share price of STPK. You multiply the shares outstanding from the presentation to the share price, and that gets you what is the implied market cap. So the pro forma market cap, assuming the deal goes through today, which it's not, this is what the implied value of STEAM is worth, or STEM, excuse me, STEM is worth. And so looking at Yahoo Finance isn't right. You have to think about it this way. So then what do we think about, in terms of growth projections? So here it is. I'm effectively saying their internal projection for 2021 is lowballing it, and that there's a good chance they do even better. So I say 149 to 162%. They were saying 348% growth. I'm saying 350 to 390%. I'm saying long term their optimized margins are 25 to 35. One might argue that if you're looking out 20 years, this optimized margin should be even higher as you layer in more and more software contracts, but still 25 to 35% strikes me as reasonable. Then slap on a tax rate. I mean, you can toggle around with this as your heart seems fit, as you seem fit, as your heart desires. And so you put on this 25% tax rate, and you can see what the implied earnings multiple is, like 130 to 200 times. This is based on optimized margins. They're not there today, but assuming it's valued based on where they're at in maturity, then the return you get is purely based on what's the revenue growth from here until maturity. That's the reason why I like thinking about these optimized margins, is like what's the margin at maturity, and then the delta between now and then is purely the revenue growth. And so, then the next question is, well, what's your revenue growth over the ensuing years? And the truth is, I'm sort of penciling out in the base and high case revenue figures that could potentially go even higher than their model, just to sort of play around with these figures, because here it is in their model 2025, they're saying revenue of 944, and here it is in my base case, I'm saying a little over that, $1 billion. So, and then slap on a multiple of 30 to 40 times. And show the reason why this is important, I would say, of showing this relative to their model is if you thought their booking assumptions, let's say, was a little too aggressive, like how come it's accelerating versus, sort of being in the 50-60% range. How can we assume that this actually, they put up these types of growth numbers that are even better than what management's forecasting, which is generally something in my mind that's really risky to do. Assume management is being too conservative, especially when it's in their interest to get a deal done. So why is it important to show this higher range? And the reason why is, I think, in order to justify an attractive return, you'd need to bake in these sorts of figures. Now, of course, you could say, well, wait a second, your end multiple 5 years out maybe should be higher. Maybe it should be 40 times. Maybe people are like, this is just such an incredible growth story. It's trading at 50 times and it's 40 times in the base case. But I like to have a range of possibilities, and it does sort of show you that if you don't have a really lofty full valuation 5 years from now, and if you don't have 70% annualized growth to $1.3 billion, if you only increase by 4x from 2021 and your end multiple 5 years from now is only 25 times, then you do have a lot of downside from here. You have 50% plus downside. So that's part of the reason why I'm sort of showing this is sort of an educational exercise of saying, look, wait a second, if you don't do better than management's forecast, like here's exceeding management's forecast, and you sort of just break even over the next 5 years, partly because the stock has gone up so dramatically. I mean, look, this deal was priced at $10. It's already at 40. It's a 4x from where it was just a few months ago. So people have learned that this is a great company, and this is the challenge with investing, is it's sort of like horse betting, where you go to the stable and everyone's, you go to the track, and if people start recognizing it's a great horse and you're going to have great odds, then the odds change as people bet more. And that's exactly what happens with the stock price that keeps going up, is people are saying, oh, I know this is a good company, but now your risk reward's different, because longer term, if fundamentals are going to drive your investment, it's going to be tougher and tougher for you to get that exceptional return. So, as I look at STEM, I like what they're doing. I like not only how they're doing it, being an agnostic provider, but I also like their mission. I like the idea of, greater grid resiliency, decarbonization, making the air cleaner. I love being able to smell clean air. I mean, being able to see clear skies from one city to the next. It's fantastic. So I like the mission. I love the play. I love the fact that this is a real company with real customers all over the world, and they're selling, real products that are needed, and, saving significant costs, 10 to 30% cost reduction for commercial companies, 10 to 30% internal rates of return for the utility companies that are using them as an add-on to, let's say, their solar energy products. It's a beautiful model where you're selling the razors at a small markup, and then you get this high margin razor blade that's going to be an annuity for 10, 20 years at least, that over time will generate, which could generate very attractive financials. But at least in the near term, it will be very low margins because predominantly hardware. And so you are valuing this on the assumption like, hey, I think you're going to be a software company later on down the road. And at this time, it's really fighting over the deployment of the systems with other players. What's the risk? And this is sort of a question that you'd need to watch and how this evolves over time. What's the risk that more hardware companies start leaning in on this, saying, hey, this is such a great company. This company's worth, several $billion. What's Tesla to say, hey, why don't we roll out more and more of our own software solutions? That way this helps the utilities. That way it helps these commercial companies versus having to rely on this sort of independent third-party integrator that also has the software that's really valuable. So that's a tricky aspect of this, where it's like, hey, what's the chance that the hardware manufacturers start getting into it? And this is, in some ways, this actually reminds me of, is sort of like IBM reaching out to Bill Gates of saying, hey, can you write an operating system for our hardware? And all the value went to the operating system over the time. So what's the risk that, the hardware players in this case sort of don't wake up to that realization that they're competing with a couple other players, and it's like, hey, it's better to own the software than the hardware long term, especially when you see the 80% gross margins. So that's a tricky part. That I'd argue is a thesis killer to this setup. It's something to watch, at least in the immediate term. That said, the fact that they're beating Tesla in terms of rolling out in some states, it does suggest that there is something special about what's going on here. Plus, the last component is that the valuation isn't that compelling. Like, in order to have really attractive returns, where I said 150% return, you need the fundamentals to perform even better than the lofty expectations that management lays out. And at the end of the day, I think I can just find better risk rewards, better setups where it's like, hey, I think there's only 30% downside, but 200% upside, or 20% downside and 300% upside, or 150 upside. So, I think there are better risk rewards out there, and I've called them out to the Unrivaled Investing Journey subscribers. They know about it. Shortly after this video, I'm going to post my monthly update, my new monthly potential multi-bagger, where I'll go through actually all of my prior potential multi-bagger calls, and you can see which of them have already gone up over 100%. The answer is quite a few, and at least so far, thankfully. And so that's part of what I do for unrivaledinvesting.com. If you click on Journey, where it's exclusive content, what I buy, what I sell, what I hold, at least once a month, calling out a potential multi-bagger, a type of company that I think can go up hundreds or thousands of percent long term, where it's like, hey, I like the valuation, and I also like the story, or I like their existing growth rate. I also have an educational series to try to teach the viewers that are interested. And also, if you're interested, there's a full catalog of contents below, so you could sort of learn a little bit about it if you're interested in exploring, and you can see all the exclusive posts. Just click on them to see more. So the catalog of contents will be in the description of the link below. And I also do, another key aspect of the exclusive content is I do follow-ups. Sometimes, not every time, but often on these YouTube videos, I'll do an exclusive follow-up for my Unrivaled Investing Journey subscribers. For example, this video is already over 30 minutes, which is a long time. And so for the Unrivaled Nation, then I post the exclusive additional take For example, here I'm going to do an additional take on STEM for the folks that just can't get enough, because the truth is there is even more to the story that I haven't called out, such as potential tax credits from a new, President Biden's administration, which could impact their figures, as well as a couple other things that are worth considering as you look at this. And at the end of the day, just finding one potential multi-bagger can change your life journey. So if you're interested in following my journey to try to find these potential multi-baggers, go to unrivaledinvesting.com, click on journey. And if you enjoyed watching this video on STEM or STPK Spac, please make a point of subscribing and hitting that thumbs up button. Thank you so much for watching.